In this video, we will look at implementing the Merton model for finding out the probability of default over a t-year period. Earlier in our previous video, we have looked at over a 1 year period, what is the probability of default. Right there we have said the debt is, it's a debt, one time 10 coupon bond, but the time to maturity we have set it as 1 year. But generally what we see is the average maturity of the debt of the firm, right? Average maturity period generally is much greater than 1 year. So this is what I have to really take into consideration when I am trying to find the probability of default. Now, though I can simply replace in the option pricing model, I can replace the T minus T from 1 to 5 if I am looking at a 5-year time frame. But a few additional things that I may have to consider is during this period there is a chance that the dividends might be declared to the equity investors or interest might be paid towards the creditors. So there are some kind of interim payments. Better to take them also into consideration before we are computing the entire stuff, which means it's better that I accumulate or accrue both the dividend as well as the interest to the final date of the final maturity date. So here there are a few assumptions that we are making. Still we talk about only one coupon bond, right? Instead of a 0 coupon bond, we are talking about a coupon bond, and the maturity, whatever we want to so typically the maturity we will look at it as the maturity of the average maturity of the liability. So we have different kinds of liabilities. I'll look at the average maturity period of the liabilities. So to that particular average maturity period, let's say I got 5 years as the average maturity period of the liabilities. Then what I'll do, all the interests that are going to come in each of the years, the dividend payments that are going to come up in each of the years, we try to accrue them towards that maturity period. So if an interest of 100 is going to be declared in the next 1 year, I'll try to accrue it what would be the value of that at the end of 5 years, right? So generally, because I'm accruing all these things, so we are treating them as liabilities that have higher priority than the principal of the bond. So we are typically adding up these things towards the overall liabilities itself. Now, as a matter of computation of that, even when I look at any balance sheet, the liabilities wise, we have a breakup, right? Generally, we have current liabilities and the non-current liabilities. Current liabilities are the one whose maturity is less than 1 year, and those whose maturity is more than 1 year, we are terming them as either non-current liabilities or the long-term liabilities. So what we can simply do is, I can assume the average life of current liabilities to be around 0.5 years, and I can even assume the non-current liabilities also to have some period. If I can get the data, fair enough. Let's see if we can get the data for the Reliance regarding this. Okay, here non-current liabilities is 74,926. So let me make the entries. Non-current liabilities is 74,926, whereas current liabilities is 95,566. So this is what is the number for Reliance, and let me see if I can get a much detailed breakup of this. Typically the term period. So let me look at the long-term borrowings, which is the note number 3. So let's go to the note number 3. If I can get some kind of a clue. Okay, non-convertible debentures, this is the current. Now, we don't have a time period for which the bond is applicable. Okay, we have some kind of schedule, maturity and the rate of interest for the different kinds of bonds. So we have the bonds at 6.25, at 8.75. So different kinds of bonds for different time periods. Now, this is, so you see some of the loans are there for 6 to 12 years. Some of them have 2 to 5 years. Right? So this is the total stuff. So just to simplify the case, I may take the average maturity, right? Probably this is the amount. And just for understanding, I'll say average maturity. Again, I'm not going in detail, but we can very well try computing the entire average maturity. Here, let's say I'll take 8 years. Here, I'll assume 0.5 years. So some such kind of thing I'm looking both for non-current as well as current liabilities. So based on this, I can very well find out, right, what is the average maturity. So I'll compute the average maturity, wherein I'm looking at the current liabilities multiplied by the average maturity of the current liabilities, which I have taken as 0.5, plus non-current liabilities multiplied by the average maturity of the non-current liabilities divided by the total liabilities. So this is what is giving me the typical average maturity period. So the total liabilities I am taking as both the summation of non-current as well as current. So this is giving me that the average maturity period is approximately 3.8 years. Right? If I am rounding up to 2 digits, it's coming out to around 3.8 years. Now this is the first step. Right? I try to, as a part of my first step, I try to break up the total liabilities into current and non-current. Try to find out the average maturity for each of them and use this amount and average maturity. Similarly, for current and non-current liabilities, use that, and based on that arrive at the average maturity of the entire set of liabilities. That is my step 1. Then in the step 2, what I would like to do is, I would assume that the dividends are typically paid annually. Right? The dividends are typically paid annually and they grow every year at some rate G. So based on that, I can very well find out the dividends that are going to be declared at each of the periods. I can very well find out what is their accrued value at time t, which is 3.8 years as per our example. Right? The dividend that are going to be declared every period, to what extent are they going to accrue to? So generally we can accrue them at the risk-free rate of return. Right? We can very well look at the dividends are growing. Either I can take the G, or I can very well assume that the dividends are growing at the accrued rate of return. So which is the risk-free rate of return, which I can take it at 7.25% itself. The same logic I'll do with the interest as well. Right? All the interest I can look at historically. What is the interest the company has paid? So let's look at the Excel sheet here, sorry, the annual report out here. Let me see what is the interest that they have paid. I see that the interest that they are paying is around, right, 2,367 crores. So this interest, again, I can keep it accruing at a particular, or I can assume that it can grow at a particular rate. And so whatever is the coupon, so these are all, if I'm assuming that this is a coupon and the coupon is paid every year, I can very well accrue this coupon number as well, right? So I'll take the current year's numbers. Let's say the interest I'll take for the current year, which is the financing costs, 2367 crores, right? So I have one information. I can also look at the dividends. The dividend of from the cash flow statement, I'll try to find out what is the dividend paid, 3268. Right, the dividend is coming out to 3268. So I'll take the dividend as well. We'll try to accrue them to the maturity period, which is the 3.8 years. Now, if I try improvising this model a little bit, the basic Merton model, so we are assuming that the payoff to the equity holders happens at maturity. But look at, now at maturity, assume that the value of the assets is much lesser than just the dividend and the interest itself. Means very, very lesser than the dividend and the interest that is supposed to be paid. Right? Let's say we are accruing the dividend, and that is what I am calling as D. We have accrued the interest, and that is what I am calling it as I. So yearly dividends accrued up to the maturity period is D. Yearly interest accrued up to the maturity period is I. Now, if on the expiration date T, if I see that the value of the assets is falling below the summation of both debt, the dividend and interest, first of all, the firm is in default because its assets are not even sufficient to pay the dividends as well as the interest also. So, in this case, the equity holders should get their share of dividend because this is a dividend that the company has not paid. So they are going to receive whatever is the value of the firm at that particular point. They take a share of it, the dividend divided by dividend plus interest. So this much goes to the equity investors, and the remaining goes to the creditors. The creditors will get I by D plus I times 80. Especially when the value of the firm is much lesser than even the dividend and the interest put together. But if I am looking at, okay, if I am looking at 80 plus if I am adding the dividend and the interest, if it is simply lesser than the liabilities plus dividend plus interest, which is telling me that these two are sufficient to pay this. So 80 is only lesser than L. So the payments to the equity investors in the form of dividend and the interest payment to the lenders is already sufficient, whereas the principal is not getting fully covered by the assets. So in this case, the equity holders are only receiving the accrued dividend D, and remaining is simply going towards the lenders. Whereas in the other case, if the value of the assets is greater than this entire stuff, then the equity investors are going to receive something, which is the balance. So after the payment to the principal as well as the accrued interest, whatever is remaining, that is what will be the payment to the equity investors. So if I am looking at all these things together, The position wise, what is the position for an equity investor? I am looking at D by D plus I share in the asset. So I have it's equivalent to a share of D by D plus I in the asset, underlying asset, plus I'm going for a short call because I'll receive this only if this is going to happen. So which is equivalent to a kind of a short call again on D by D plus I on D by D plus I number of assets. I'm going for a short call on it where the strike price X is D plus I, and along with that, if I'm looking at this payoff, it's a kind of a call option. I'm going for a long call on the asset where the strike price is L plus D plus I, because if the asset value is more than L plus D plus I, because maximum of AT minus of L plus D plus I is what is typically received. So this is what is going to be the equity value. So we are again we can very well use a Black-Scholes kind of a formula to value this kind of an option. So in this case, I know that the value of the equity ET is again the same logic. The value of the asset, which is the current value of the asset, times ND1 minus now the strike price L plus D plus I e power minus RT minus RTS T minus T and D2. This is the call option. Plus I have a short position in the call for D by D plus I times the asset. So D by D plus I times now the current price of the stock, the price of the stock, the price of the asset, value of the asset at time t minus this part, value of the asset at time t times ND1. So this is the debt portion of it. I mean dividend divided by the total accrued values, plus I'm taking with a strike price D plus I, the strike price. So this is the spot price. So I'm taking plus D plus I times, so this is stock price. So this entire thing is my stock price, and multiplied by, which is the asset value, D by D plus I, because the asset value if it is lying between the two. So D by D plus I times e to the power of minus RT x e power minus RT and D2. Right, this is the position in the asset and this is the position as a short call in the asset. So both of them I am taking together. So here it is working out that my D1 is log, if I am looking at it from this perspective, D1 is nothing but log AT divided by A plus D plus I plus R plus sigma squared by 2 into T minus P divided by sigma root T. Similarly, D2 will become D1 minus sigma root T. Similarly, here another D1 if I am taking for this, probably I'll call it K1. In this case, it is log AT by the strike price is D plus I. Log AT by D plus I plus R plus sigma squared by 2 times sigma squared by 2 times T minus T divided by sigma root T, and K2 I can call it as K1 minus sigma root T. And just like the earlier case, in a single case, when we have taken sigma E times value of equity is equal to sigma which is the asset volatility times the value of the value of the asset at time t times nd1. Here also we are going with that proportionate representation. So instead of sigma e, earlier the sigma e was at times sigma times nd1 by et, right? So the same logic if I am putting, so this would still be the same. The first part is still the same. So sigma, it is becoming sigma times at times nd1 divided by et. So this is still the same. But now that I have another short position, I am taking it as sigma times at times. Now the nd1 for me is becoming d by d plus I times 1 minus of nk1, and divided by et is still the same. So these two things put together, I am getting my sigma e in this kind of a multi-year scenario. The only difference is in a multi-year scenario, we are simply taking all the dividends declared during the period as well as interest that is declared during the period, accruing it to the average maturity period of the liabilities. Right, so that is what we are typically putting as a part of our Excel computation here. So let's try to model that entire stuff. Right, so we will try taking up a few things. So initially, to start with, we have equity value. So we know the equity value, which is that from the data I can very well take the number of shares. So the number of shares I think we have seen earlier. Let me see what is the number of shares. The number of shares that are issued (3236). The total number of shares that are issued 3236. So I can very well find equity value means 3236 multiplied by whatever is the latest value of the asset, price of the share. So these many crores is the equity value. And the volatility, right? Equity volatility, if I am looking at, I should find out first of all directly also I can find out which is the daily volatility, which comes through my standard deviation of the log returns. I am multiplying it with the square root of the count of this particular column. So this is giving me that the equity volatility is somewhere around 27.39%. Similarly, I can get what are the liabilities of Reliance. So the total liabilities, so I have already broken it up, but the total liabilities for me is the summation of these two. So this is the worth of the total liabilities. I'll assume a risk-free rate of 7.25%. That is what I'm taking it as the treasury bill rate of 1 year. The time period or time horizon, let me call it, that I can take it as the average maturity period that I have got. So I'll take it as 3.8. Now I should consider what is the kind of a coupon that they are issuing. So if I look at the interest that they are giving every year as a proportion of their non-current liabilities, I see that the coupon that is typically being coming out is around 3.16%. And I could also see that the dividend that is being issued during the period is around 3268. So this is the dividend. And now I can very well assume that the dividend growth rate, right, I can keep it Okay, let's see how the dividends have been growing year over year. Right, that should be a better way to understand, or let me just go here, check out what is the change in the dividend. So I'll use moneycontrol.com website just to understand how the dividend pattern is changing for this. So I'll look at the corporate action, I'll look at dividend. Okay, so every year they are giving the dividend. So 90, 95, 100. Okay, this is the percentage. So of the face value per share. So it's basically like they are giving a dividend of the face value is still around 10. So they are giving a dividend of 10 rupees per share. Earlier it was 9.5 rupees per share. So I can assume that the dividend growth rate is somewhere 10 divided by 9.5. So around 5% I can assume. I'm taking 5.26% as the approximate dividend growth rate of this company. So based on this, I can very well find out for the next 3.8 years to what extent are these dividends and the coupons going to accrue. So for the coupons, I'll take the risk-free rate. The coupon are probably the coupons I can still take. The coupons that I can still take, what should be the growth rate? I can take the risk-free rate itself. Whereas even for dividends, if I want, I can very well assume they growing at the risk-free rate, but whatever is the rate. So now we can make a simple schedule, the year-wise. Let's say year 1, 2, 3, 4, whatever it is the time period. Let's say I'm making some schedule for up to 10 years. And I have the dividends that are expected each of the years and the interest that are expected each of the years. So whatever the dividend that is going to come up, I want to accrue it to the 3.8 period. Right? I want to accrue it to the 3.8 period. So how is that I can do? Let's say for the first year, I'm looking at the dividend. So if I can simply say if this particular period is lesser than the maturity, then for that particular period, all I am saying is whatever is the dividend that is declared in the current period, I will increment it. I know that it is going to grow at the rate of the dividend growth rate. So I'll take the dividend growth rate, let's say as this much. I'll expect that the dividend will grow at this particular rate, and I'm raising it to the power of the number of periods, because this is the dividend that I am going to get at the end of 1 year. This is the dividend that I have got in the current year. So there will be an increment. This is the dividend that I am going to get at the end of 1 year. Now that dividend I want to accrue it using the risk-free rate of return, e power RT. So R I will take it as a risk-free rate of return. Right, R I am taking it as a risk-free rate of return. And T is the time to maturity, but I need to subtract this one because I am getting only for the period. I mean, this is the dividend that I am getting after 1 year, so it would be invested only for the remaining 2.8 years. So the T I will be taking as something like this. So that will come out if the value is less than this, otherwise I'll take it as 0. Now going with it, the dividend here is going to be this much. So for the 3 years, the dividend is going to be something like this. The same logic I can put for interest as well. If this particular year is less than the average maturity period that we are considering, I'm looking at the coupon that I'm going to get. This is the coupon that I'm going to get, multiplied by the value of the liabilities, which is the interest that I've got altogether. So I can take the liabilities amount. So every year, that is what is the number that is going to come, because it's a coupon that is going to be more or less fixed. And this I am multiplying it with e power RT. R e power RT. T is T minus T. So I'll take this minus this. Alright. Otherwise I'll put it as 0. So I get this is the interest for year 1, and then probably I can go ahead with year 2, year 3 kind of stuff. So these are what are going to be the interest in each of the years, right? These are what are going to be the interest that are accumulated. Probably I can do it on just the long term, not the current. So probably what I'll do is I'll take the non-current liabilities only instead of taking the total liabilities, right? Or probably the coupon rate has to be changed. Fair enough. So based on this, I can very well have an accrued dividend. So at the end of 3.8 years, the value of the dividend that is going to be accrued is somewhere around 12,000, and accrued interest at the end of the period is again going to be the summation of this, which is around 18,000. So I got these two things as well. Now based on this, I can compute my asset value. Now that I have the equity as well as the liabilities, again now the process is more or less the same. So the asset value, initially I'll start off with the equity value plus the liabilities value. That's the starting point. Similarly, the volatility of the asset. Volatility of the asset, I can very well take with that kind of an assumption. We have gone with sigma E times the value of the equity is the value of the asset times the volatility of the asset times ND1. We can start off the value with ND1 being equal to 1. So in that case, the volatility of the asset will be the volatility of equity multiplied by value of equity divided by the value of the asset. Equity value multiplied by equity volatility divided by the value of the asset. So this is what is coming out as a part of my asset volatility. Then I can start off with the Black-Scholes model, D1. We have already given the formulas for all of them. So I can say log asset value divided by L plus D plus I. So L plus D plus I. So these are the three things. So log AT divided by L plus D plus I plus R plus sigma squared by 2. R plus sigma is asset volatility. Sigma squared by 2 times T minus T is coming out to 3.8 divided by, so I have to close this in brackets, this entire thing, divided by sigma root T. So sigma is the volatility of the asset times square root of T. So which is telling me that this is my D1. D2 is going to be D1 minus sigma root T, right? D1 minus sigma into square root of T. So from here I can find out ND1, which is the norms disk associated with D1 comma 1. Then similarly I'm doing ND2, which is also coming out in the same fashion, norms disk the D2 comma 1. So giving me that ND1 and ND2 are approximately or almost equal to 1. The same logic I can do with K1 and K2 as well. So in case of K1, I'll take it as log this is my A, log A T divided by D plus I, which is the accrued dividend plus accrued interest. So log AT divided by D plus I, rest all remain the same, right? R plus sigma squared by 2 times P minus T divided by sigma root T divided by sigma square root of T. So this is working out to be my K1. K2 goes as K1 minus sigma square root of T, sigma square root of T. So my K1 and K2. So I can very well find out NK1 norms disk associated with this particular value, right? And similarly I can find out NK2, which is also coming out as norms disk associated with this particular value. So these are my NK1 and NK2. Now using these, I can find out the value of the equity and the value or the volatility of the equity. The value of the equity from the formula is directly coming out. Now we already had a formula where we are looking at AT times ND1 minus, so x by e power rt is like in this case my x is the liability is plus the accrued. Liability is plus accrued, all three of them put together. So this is by x e power minus rt minus r T is 3.8 years. So x e power minus rt times nd2 plus, because of the short position also, first of all having a d by d plus I position in the assets and d by d plus I short call in the assets as well. So even those need to be added. So I am taking it as d by d plus I. This is d divided by d plus I. This I am multiplying it with AT minus of AT times ND1. So AT minus AT times ND1, or here we call it as NK1. So I'll take it as NK1 plus D plus I. So because I am taking the strike price as D plus I here, so I'll take it as D plus I times d plus I times e power minus rt minus r times t nk2. So this becomes nk2. So this is what is finally working out, which is leading out to equity value being 33 lakhs 3,003.30 million is what is the equity value that we are getting here. And the same way I can very well go towards the volatility of the equity. I can go with the volatility of the equity, again going with the same process, where I can take it as per our formula. Right, this is the formula for equity volatility, so I can very well consider that. So I'll take it as sigma, which is the asset volatility, multiplied by the value of the asset by the value of the equity, So I'm multiplying this with ND1. So I'm just simplifying the stuff, plus D by D plus I, D by D plus I times 1 minus of NK1. 1 minus of NK1. So this is what is typically working out to my volatility of the equity. Here my equity volatility is this much. Oh, I made some mistake somewhere. So it is this into this by this multiplied by ND1 plus D by D plus I times 1 minus ND1. Right, D by D plus I times 1 by 1 minus NK1. So where is it going wrong? So I am taking it as sigma, which is the volatility of the asset multiplied by the value of the asset divided by the value of equity. Okay, here I have to take the value of the equity to be this number, multiplied by this entire thing needs to be multiplied. I think some bracketing issues. Right, we'll keep one bracket out here. So multiplied by, I have ND1 plus ND1 L17. Oh, I've taken it as D1, sorry. So here we should take it as ND1. So this is the mistake that I have made. So this is the ND1. So if I simplify it, yes, the volatility is coming out to around 27.17%. Now I can do the same kind of a simplification by minimizing the error values. Alright. Now from this we can try finding out the actual asset value and all that stuff, and finally compute the default. Right, the probability of default we can very well compute. So we'll take the squared error to start with. That's what we have done even in our earlier case. So while computing the squared error, I'm taking the value of the equity, which we got through the Merton model, divided by the value of the equity that we are getting here, minus 1 squared. Similarly, I'm looking at the volatility as well. The volatility that I'm getting through my model versus the volatility of the equity that we got from the market, minus 1 squared. So this is what is the squared error at this moment. Right, I want to minimize it to 0. So that is what we are giving as our input to the solver. So let's try minimizing this by changing these two. This is what was the initial part. So what we'll do is we'll go with the solver again this time. Okay, so the objective, this has to be minimized by changing the asset value and the volatility of the asset. So let's try solving it. We have got something close to 0. So the equity value is very much 327 and the volatility of the asset matched this, and squared error came very much closer to this. So based on this we can easily work it out. Again, our probability of default in the next 5 years, if I have to look at, or in the next 3.8 years, which is 1 minus of ND1, right? So I'm looking at both of them. So if I'm looking at the probability of default, okay, if I look at my 1 minus of ND2, because n of minus D2, it's very much closer and closer to 0, right? Even if I increase, yeah, probably the default probability is coming very close to 0 because my D1 is exceptionally higher. Or I can very well take, so probably n of minus D2 is something that I can very well look at. So which is working out to again close to 0%. So the chances of default are much slimmer. But on the other side, if we quickly look at the equity value being not so high, let's say just to test it out, the equity value is just 300,000, right? The equity value, let's say, is just 300,000. So that's where we want to go ahead with. So let's test it out now. If the equity value is only that much, now the equity value is coming this and the error is too much. So probably if I'm running the model once again, let's see to what extent it is simplified. The equity value has come to this. Asset value is this much. Still the ND1. So there is some problem with the D1 calculation. Let me just check. Log 18 divided by this plus this plus this. So D1 can't be so high. Log 80 divided by this plus R plus sigma squared by 2 multiplied by T. What about if this being just 1 million? If this is 1 million, what is happening? Okay, yeah, even in this case, no, there is something wrong with the D1 calculation. Let's quickly look at 80 divided by log 80 divided, okay. So this has to be in the bracket. That is what is causing the problem. So this entire thing needs to go into the bracket. Now, yes, this is where the difference comes. So let me go ahead again redoing the stuff. So there are 3236 million shares, crore shares multiplied by the share price, the recent. So this is giving me that. Let's go back now again to run the model again. So this time it is telling me that the default probability ND1 is this much. Now the probability of default here is coming out, so 0.9999, so there is some probability of default 1 minus ND2 when I am doing it. Probably there is a 0.00029 kind of a probability. Very rare, but yes. But if I am saying instead of the equity value being this much, let's say the equity value is only 300,000. Then if I am running the solver, see, alright, what has happened? So let me make the equity value 3236 multiplied by the stock price. Why did this go wrong? Log for the asset value, why did it go to 0? Equity value plus the liabilities. Alright. So if at all the equity value is going much lesser, let's say this is the equity value, then the asset value is going to this, and we are seeing that there is a probability of default. Now this time when I solve it to minimize, now it is showing that if the equity value is only 300,000, then there is a chance of default. Right, ND2 is only this much, then the probability of default is going to start. If the value of the equity is only 300,000, then within the next 3.8 years, there is a chance that the default can occur. There is a probability of 0.28% that the default can occur over the next 3.8 years. So this is where, depending on the value of the debt versus the value of the equity, proportion of debt and proportion of equity, we can very well talk about what is the kind of chance that the default can occur over a 3.8 period. Now the same logic, if I have to go for per annum kind of a probability of default, all I can simplify is 1 minus of whatever the difference, 1 minus of 0.28% to the power 1 by the time period, right, to the power 1 by the time period. So the time period for me, I'll take it as 3.8 years. So which works out to almost 0.07%. 0.07% is the probability or annual probability of default going by this. But yes, this is the case when the equity value is only 300,000, but current equity value of Reliance Industries is this much. So going with that and again re-executing our solver, it looks as if the chance is 0. So the probability of default is very close to 0 in this current scenario. So that's how we can use the multi-period kind of a horizon, and we can use it to estimate the probability of default of any company. Now this itself can go as an input for the computation of the credit spread as well. Right, if I am more interested in looking at the probability of default and using that as an input for the computation of the credit spread, right, on the liabilities, we can very well determine the yield. So what we know is the interest is accrued. So typically what is paid at the maturity to the creditors is the value of the liabilities plus the interest that is accrued. Right, that's the amount that has to be paid at maturity using this model. And the current value of the bond or the debt I can take it as the total value of the asset minus the total value of the equity. So I can equate this to L plus I, that is discounted at 1 plus yield to the power t minus t. I can solve for this particular y, right? One value of the bond I get through this. This should be equated to this one. So whatever is the discount rate that does that, that is what will come out to be. So if I am simplifying it, it is nothing but 1 plus y times t minus t is L plus I divided by AT minus ET. And based on this, 1 plus I goes to the power 1 by t minus t, and y goes to this minus 1. So I can apply the same formula, liabilities plus accrued interest. So if I have to really find out the credit spread, right, or probably I call it as the yield to start with, then we'll subtract and compute the credit spread. The yield that is expected for a bond here is nothing but L plus I. This is my L, and the accrued interest is happens to be this one. So L plus I divided by AT minus ET, whatever is the value of the assets. So this is the total value of the assets minus the total value of the equity. So this is becoming 1 plus y to the power t minus t. So this entire thing I do it as to the power 1 minus 1 by t minus t. T minus t is 3.8 years. 1 by t minus t. This entire thing I do a minus 1. So this is coming out that the yield on this particular entity is around 7.52%. Wow. So for this kind of an entity, the yield is 7.52%. Now this I can very well use to find out what should be the credit spread for this kind of a bond. So for the kind of a bond which it is issuing, the credit spread is nothing but the yield that I got here minus the continued form of the risk-free rate of return. So I'll take it as, right, I'll take it as whatever 7.52% minus e power r minus 1. Right, I'm finding out the equivalent annual yield find. So the credit spread works out to 7.52 minus of e to the power of the risk-free rate of return minus 1. So working out to almost 0%. Right, the credit spread is just around 0.0004%. So that's the kind of logic that I can very well give for finding out the credit spread also associated with the bond. So it's a kind of a spread that is typically relatively risky kind of a debt. But in real world, what is observed is the spreads that are produced by the Merton model, here it's very, very low, right? 0.00004%. So generally they are very much lower than what are the spreads that are observed in the market. To a large extent, they underestimate the default risk because of the assumption of the normality of or log normal behavior of the asset prices. They underestimate the default risk, and probably because of that reason, what we see is the Merton models typically show a slightly or much lesser credit spread compared to what we are observing in the market. And even on the other side, when we look at the spread, they also contain a component of illiquidity. They also contain a component of a tax disadvantage associated with the corporate bond. But those things are not getting incorporated into the spread that we are computing through this process. So even that could be another reason why we cannot rely on the spread that we are getting exclusively through the Merton model. But what we should understand and appreciate is this kind of model gives me a kind of a broad picture in terms of what is the probability of default of this associated bond or associated company in by using the structural model over a T period horizon. I hope you are able to get some amount of information through this video. If you have any further queries, you can very well get back to me by giving me a call on the number given below or sending me an email to the email address that is being shown. Thanks a lot for listening to this video. Thank you very much.